You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit ORATS.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody, that music means it is time once again to roll out the Advisor's Option Train, our monthly glimpse into the world of advisors and asset managers, how you are using options, how you should be using options, some education, what's the buzz, what's going on in the world of options you may have missed, your questions, and a whole bunch more. My name is Mark Longo from theoptionsinsider.com, as well as, of course, on the ever-exciting Options Insider Radio Network. Just got off a great pro Q&A session with the one, the only Mr. Dan Grams just about an hour and change ago. That was fantastic. Diving deep into all things futures, options over there. A lot to talk about on that side of the fence as well. If you are intrigued by those, you want to check them out, see what you missed, theoptionsinsider.com/secret club is the place to go to learn more. And of course, however you listen live after the fact, we love you all. Keep hitting us up. Questions, comments, insights, pearls of wisdom. Are you an advisor looking to learn more about these markets, how you should be trading options? Maybe you're a client who's thinking about what your advisor should be bringing to the table. Maybe you're an asset manager who's completely clueless about all this stuff. Either way, hit us up. Let us know. We do love to hear from all of you folks out there. Let's see who we're hearing from on the program today. It wouldn't be an episode of the Advisor's Option if I was not joined by my cohort, my partner in all things Advisor's Option crime, Mr. Matt Amberson, a.k.a. the Oracle of New Hampshire, a.k.a. the founder over there at ORATS, a.k.a. Options Research and Technology Services. That's a lot of AKAs. Mr. Matt, welcome back to the program, sir.
I like the secret club. That's neat. I had the honor of being one of the first on your pro site. So that was a lot of fun. It's great to be here, Mark.
Didn't you kick it off? Weren't you the first in the hot seat, sir?
I think I was the first.
That's a feather in your cap that can never be taken away, sir. You kicked off the Secret Club before it was even called the Secret Club. It's just got a cool new moniker now. We like to call it that, but it's a secret. We shouldn't be talking about it as we keep on rolling right on into the P&L statement.
What the heck happened in the options markets since our last episode? Let's find out with the P&L statement.
That transition is probably more apt maybe this episode than ever, just because that's a great question to ask. What the heck happened in the options market since our last show? You know, Matt, I always joke that every time we come on and do this show, something crazy has happened in between this and the last episode. And we're certainly seeing that again, turned up to 11 here coming into this show. Of course, we are recording this at the tail end of November here, late in the year of 2021, listeners. And we have seen the rise of a new variant out there now in COVID, known very scarily as Omicron. Sounds like it's straight out of a sci-fi movie. People were joking on some of our shows earlier this week. They should have called it Unicron to keep with our 80s theme here on the network. But that's sent the markets into a tailspin on the shortened Friday session last week. Massive sell-offs, over 2% across the board. The question was, coming into this week, would the rally continue or would the sell-off continue? And the rally took hold. No sell-off. Everything seemed like it was green on the screen. Most of the major markets rallying ho. And then we come into today and we're flipping that script yet again back to the dark side. Most of the major indices off pretty firmly. The S&P off about 1 2/3%. Dow off 1 3/4%. So once again, we're back in the red. So Matt, there's a whole lot to unpack here. Let's start there. What are your thoughts on this massive resurgence of volatility and this lingering threat of the Omicron variant and what it poses to the market, sir?
Well, November has been very interesting. We've finally stalled this step-by-step up since the coronavirus, and we're getting some, good volatility here. The Omicron, they conveniently skipped a letter. Between new and Omicron is Z. And for
yes,
political purposes.
A lot of conspiracy theorists out about that one, yes.
They skipped that one for, and all the fear mongers were out there, but the source where they found the actual variant was down in South Africa, and the doctors are saying it's not that big of a deal. So, it was a nice bounce back, but then we're right back down today. So I thought that was an interesting move. So there's a lot going on out there, a lot of geopolitical. A lot going on with the variant, and then I think what happens is you just start getting the market moving around. Inflation fears. I mean, they're getting so many more numbers that inflation is going to be bad. So that's not going to be kind to the market, especially with a lot of these high flyers that have so much emphasis placed on far out earnings. So that's going to be discounted greater under a higher inflationary regime. So, I think that we're seeing some, Omicron and stuff, but I think there's some underlying issues out there, and it's going to be interesting to see the way it plays out. A lot of the technical indicators that we use from a volatility perspective, we're turning up mid-November. Some are just getting to kind of big warning territory. Our contango, which measured not of VIX but of the S&P 500, and then also we do this forward volatility relationship ratio. When the market gets really pricing out of whack, that starts to deteriorate, and that's been deteriorating. So, interestingly, the slope, the put call skew, the puts are still high. They're just been pinned there for about 4 months. So it's an interesting market. Obviously the ball is kicking up. SVXY and UVXY going pretty crazy these days, and it's an interesting market out there, Mark.
You were pretty early back last year when all this stuff was still kind of in the ether there before the big sell-off in March. You were kind of early thinking that this new vol regime had some legs to it and this pandemic vol was going to be real. What are your indicators telling you now about this Omicron vol? You think this is going to have some legs, or do you think perhaps this is just a, we saw on Friday it was heavy, then it was a flash in the pan yesterday, and then it's back today. So this have some legs, Matt, or you think this is kind of just a flash in the pan yet again, sir?
Well, whether it's Omicron or, like I said, inflation or whatever else is going on, this is good. This has a little bit of legs. We're seeing some pretty good technical damage done to the market. Like I said, it started about mid-November, and the way the market feels to me, you know how you get the feel of a market when you're an ex-market maker. You have to, I went on a lot of feel, and especially standing on the floor with the OEX and the SPX markets, they'd start screaming and you say, "Whoa, what's going on?" And then all of a sudden, a second later, all your little stocks start going down. Well, the way it feels to me right now is very skittish. Like any reason that the market could have to have a bit of a panic. And, we're seeing now, you remember, we haven't had these, and now we're seeing them. So I think it's going to, if I had to predict, which I often do, I think it's going to be here for a bit. We're going to see some much higher volatility, much more movement in the stocks. And again, whether it's Omicron, which I don't really think that's the big deal. It's just, it's just a concerted, there's a lot going on geopolitically, but, we look at the markets, and the markets are pointing to, some damage that we're not done with this yet, Mark.
Well, we are also not done with earnings volatility, so let's dive into that next.
Earnings announcements can move markets, but what is the options market telling us about upcoming earnings events? Let's find out with the Earnings Volatility Report.
All right, Mr. Matt, when you're not busy talking to me here, you're off crunching a lot of numbers for our audience in the world of all things earnings volatility. This has been a fascinating season. On our last show, we were talking about, could this be it? Could this be the one where the worm turned? Because listeners, if you're listening to this show for any length of time, pretty much since the pandemic kicked off, earnings have been an afterthought. They have had really no consequence whatsoever. And no matter how much vol you priced in, or really how little vol you priced in to an earnings announcement, how much you lowered that straddle, it was never enough. The vol always came in, they crushed it, and it was just a repeating cycle we saw over and over again, just about every cycle since the pandemic began. Seasons coming in 50 odd, 60 odd, maybe if you're lucky, 70 odd % of the vol that was priced in was being actually delivered out there. But it seemed like this season might be the moment we've been waiting for, that inflection point where we actually see, dare I say it, some outperformance from a vol perspective. And, we did see that early on. First week was kind of rock'em sock'em robots, right around 98%, one of the highest weeks we've seen in quite some time. Then it fell off a cliff apocalyptically, as this market is wont to do, with 58% for week 2. But Mr. Matt, you've been crunching the numbers, you and your team out there, as we start to wind down this earnings season. How has it all played out beyond that, and did it live up to your expectations, sir?
Finally, Mark. Finally, we have a interesting, fair-handed earnings season. You described it well. We usually see not too much action in week 1. Those are all that. Well, there weren't that many, but we had a good week then, and then like you said, it fell off a cliff. But that's, I think, pretty well established that the first 2 weeks aren't that good, and then it started heating up in week 3, and week 4, moved. So finally. And then week 5 was pretty good. Week 6 was good for some small ones, and we're ending up right around 99%, which is pretty much a coin toss on the actual versus implied earnings move. So I'll just kind of rehash a little bit here. What we do is we look at the straddles, and we try to figure out how much the market is saying the stocks are going to move. We have a method for estimating what the residual straddle is, and then you see what the straddle is that you can apply to the earnings move, and that's what you compare against the actual move. So we do this all the time, every day, and we now do it for each week of the earnings season. So we say there are about 6 weeks of large earnings reporting weeks in the earnings season, and we measure those all. And we typically find is the week 4 and 5 are the best for the earnings straddles. Week 1 is usually the worst, and then the stragglers aren't usually that good because they usually price them pretty high. Meaning like a lot of these smaller firms that are reporting late, they have large implied moves, so it's hard to outpace those. So we're finally seeing a season. As you said rightly, the coronavirus just made it seem like, and all the meme stocks and all the other things going on, that the actual earnings of these actual stocks aren't quite as meaningful. Maybe with all the indexification of the market and the meme stocks and the geopolitical movement to the markets, the earnings weren't really keeping pace with the expected earnings moves. But finally they're back. My prediction is they're going to be back even with more of a vengeance as we close out the year and the next earnings starting in late January.
That'll certainly be news to a lot of our listeners' ears who, despite our warnings to the contrary, love to sling themselves some options around earnings. I'm just looking at the latest iteration of the season report. Like I said, week 1, 98%. So pretty much a break even. Week 2, 58%. So not looking so good there. Then everything else looking pretty strong. Week 3, 90%. That was the weakest of the remaining weeks, which should tell you something. Week 4, 114%. Haven't really seen that since the start of the pandemic, listeners. Week 5, 99%, so threatening to break even. And then week 6, 119%. Correct me if I'm wrong, Matt, but that's got to be the highest we've seen since all this madness began, is it not?
Yeah, that's a high one, but there aren't that many observations. But still, what was impressive to me was week 4. There was a lot of firms reporting, and that was really the real week, the real eye-opening week. And I should mention that one of the things that we came up with this last season was a test of how to trade, and a huge back test of millions of trades. We tested buying a straddle, selling a straddle, buying a calendar, and selling a calendar. And so, of those, the buying calendar, and of course, our friend Dan Passarelli will know this, but I have to test it for myself. He loves the calendar around earnings. That came out the best. And so I started, testing a few of our recommendations. And of course, with a long calendar, you want the stock to remain right at where your strikes are. So it's generally something where you don't want the stocks to move around. And of course, we get this big earnings season. Any other earnings season would have knocked the cover off it. As it stood, we still the trade still did well. I think you get that once in a while, that earnings moves trades report. So the calendar's done decently well, not as well as it would have done had the earnings season been so movementful and eventful, but it was an interesting way. I'm looking much closer at some of these trades and the earnings seasons and the way that these stocks are moving. So it's been a pretty interesting way to get into earnings. That calendar, not as nearly as much risk as a straddle, but a good way to trade these earnings, Mark.
Yes, since we got together here on the program last, you have added a new wrinkle to the earnings reports. The earnings trades report, as you mentioned, breaking down 4 trades: buying straddles, selling straddles, buying calendars, and the very rare, you don't see this too often, the selling of calendars, which is interesting in and of itself, and breaking them down by week and how they all performed and your exits and your entry points. So if that data fascinates you, and I'm guessing it does, then check it out over there, theoptionsinsider.com. Click on the Options News and Articles tab to find all this for yourself. Now you have an embarrassment of riches to look at, listeners. You have the earnings move reports, you have the earnings move results reports, you have the earnings season reports, and now, if that wasn't enough, you have a bonus report now, the earnings trade reports. Just be forewarned. You click on that link, you're going to spend some time. You're going to look at this and you say, I never thought of that before. And it's going to lead you down a rabbit hole, which will certainly be interesting at the very least, and probably profitable for you in the long run as well. As we keep on rolling, it's that time of year, listeners. Markets are top heavy, maybe a little less top heavy than they were yesterday. But still, people are worried. They want to maybe start thinking about hedging this stuff, which brings up a bunch of questions about how to pay for that. So it seems like a good time to review that now on Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101, where the name says it all. We break down some basic or sometimes more advanced options concept or strategy or technique and explain how you can utilize it in your clients' portfolios. And today we're going to start basic and then get a little bit more advanced. Of course, as I mentioned there at the top of the segment, it is that time of year, listeners, coming towards the end of the year. A lot of your clients, if you're fortunate, are sitting on some gains. Maybe this recent turbulence has added a bit of urgency to this conversation. You might be fielding some calls from your clients right now saying, hey, I'm getting a little worried about this. I'm a little bit shook. Maybe it's time to go to the sidelines or perhaps put on some protection. And that's where we come in here on the show today. So let's start with your very basic, your very standard protection, which is going to be your out of the money put. In our example, we picked a pretty popular percentage, but it's going to vary depending on you and your clients and their needs. But we picked a standard 5% out of the money put. And let's say your favorite XYZ. In this case, it could be an index, it could be an individual equity, whatever floats your boat out there. In this case, XYZ trading at a nice round number of 100. Your client's sitting on gains, let's say from around 70. So they have some nice gains. And they probably want to protect some of that. They don't want to go out too far. They want to go out about a month and about 5% out. So in this case, that would be the 95 strike that they're buying the put for. And in our example, that costs $1, which is not nothing. But also, if you look at some of the real world examples out there, you can see that probably is wildly cheap by real world comparisons. So what do you get from this position? Why are you doing this? Why are you spending $1, which is 1% of your overall holdings there, to stop yourself out, to hedge yourself? Well, as I mentioned, by doing this, you are now effectively, for the lifespan of that option, which in this case is 1 month, you are stopped out at an effective price of $94, which is the 95 strike where you bought the put. That's your strike price, plus the $1 that you paid for that put. So you're stopped out effectively at $94. The stock could go to zero tomorrow, and you would be out at 94. That far and no farther. That's why buying a put in these types of the aggressive sell-off scenarios can be a lot more advantageous than something like a stop order. Of course, the con is pretty obvious to you probably already. You already spent 1% of the value of your holdings for that protection. That's only lasting you a month. So at the end of this month, if let's say XYZ is still hanging out around $100, you probably have to come in and do that again. And you start multiplying that out in your head. You could see how that could get pretty expensive. Mr. Matt, let's start with this very basic concept here. Buying a regular 1 month put and then rolling it in whatever, an index, in an equity. It's a popular strategy, but it's also an extremely expensive strategy, and it's going to have a huge drag on your portfolio. What are your thoughts on that very basic position? Then we'll get into some of the ways we can maybe offset some of that outlay.
Yeah, so as you rightly point out, that gets expensive. And we've done a ton of back testing on this. I mean, this is one of the big back tests that we do is how to hedge your portfolio. And basically what we find is one of the worst ways to do it is with the 30-day 5% out of the money, even though it's easy to say and it's popular. Right now, that's your XYZ is 1% right now, and the SPX, it's about 1.3%. So multiply that by 12. Maybe you'll get a few of those to pay off, but you're going to be paying on average that profitability of that trade. If I recall correctly, is about negative 5%. So that's a big drag on a and that's of notion of stock price. So that's a big drag on a portfolio. Now, there are ways to refigure how to do this. So we'll get into that a little bit later, I hope. But that's my thoughts on that strategy right there, Mark.
Let's get into some of that refiguring, as you mentioned. Let's go the most basic way to reduce that outlay. You bought something, listeners, so you're going to want to sell something against it. That's Options 101, how to reduce your overall outlay. Turn an option that you're buying into a spread. So we're going to do that with our put now. Same scenario, XYZ at 100. You want to stop yourself out at 95. But in this scenario, you're not particularly concerned about XYZ going to zero. If you bought the 95 put straight up, it can go to zero and you're okay. In this scenario, you're not really concerned about over the next month it blowing, let's say, much past, let's say, the 90 strike in this example. So we go out, we buy that same 95 strike put for $1, and we turn around and sell, in our example, the 90 strike put we get a nice hefty 35 cents for that in our example here. So the pro off the bat is pretty obvious. You knocked 35 cents off the cost of that put. So your outlay for your protection is down to 65 cents. Now, the downside of that is now you've also limited your protection of XYZ. If the worst were to come to pass, if you were to blow through that 90 strike to the downside, your protection is no longer kicking in. You've effectively bought a $5 put spread for 65 cents. So the max you can make on that is going to be $4.35. It's the difference between what you paid and the actual strikes. So that's pretty much the best you can do on this put spread. If it would drop back to, let's say, 70, where you bought it again, you would only be protected for about that $5 range. So that's why you're getting that money back. That's why you're getting that discount on your protection, because you're not getting the full amount of protection. It's like buying, a whole house policy and then just insuring, let's say, your door. It's very, very specific protection here versus a much more comprehensive protection that you get with the put. Mr. Matt, what are your thoughts on taking it up a notch now and selling a put against your put and turning it into a put spread, sir?
Yeah, so now you have gone from maybe 1.2% to you've halved it to about 0.006% on that. Or wait, I shouldn't say it that way. The cost, so it is about that. So the cost of a 410 right now, for example, that's about 90% out, is 288. So, so you have that, you've reduced your cost quite a bit. And now, however, you've also reduced your payoff. So the amount that you're actually going to get protected, for example, starts to flatten out, and you don't continue to protect your investment if it goes down below that 10%. So since you've sold that, now you're not being protected underneath there. So a put spread, still the back tests on those while better, because you're reducing your outlay, still isn't the Pandora's box of you're not really finding the best strategy out there. To do that, again, we're going to have to get a little bit more calculating, shall I say, devious, Mark.
Oh, devious. I like that. Let's turn it up a notch. Let's go a little bit farther down the spectrum. Perhaps we're getting devious. I'll leave it up to you, listeners, to decide. We're going to combine now a couple of different positions that are very popular with advisors out there. I've said many times on this show that the collar is the holy grail of positions for a lot of financial advisors and asset managers out there, because most of your clients are going to be long equities or long whatever position it is. So you're going to want to buy some protection and try to finance that. A collar can be a great way to do that. Well, let's go through the whole example and break it down for you. Of course, same scenario, XYZ trading at 100. Similar setup. You're not that concerned about a massive sell-off over the course of the next month. So that 95 to 90 range is still going to work for you on the put side. So you buy the 95 put for $1, you sell the 90 put for 35 cents. So you sell that 65-cent outlay. But in our example, you go one step further. You decide, if this stock keeps rallying over the next month, if it gets to, let's say, 110, I'm happy getting the heck out of Dodge there. So you turn around and you sell a 110 strike call for, in our example, 15 cents. You're going to say, wow, that's less. And that's what's going to happen in most scenarios these days, outside of the crazy meme stocks. The calls are going to be trading at a lower volatility level than the puts. On our example, that adds up 35 and 15 cents. That adds up to 50 cents. So now you could see instantly the pro of this. You reduced your outlay. You've cut it in half now. You went from paying $1 for that put to paying 50 cents. The downsides of that, if you consider them that, having to sell the stock at 110, a lot of people wouldn't mind having that problem. You're getting another 10% on top of your position already. So it's not exactly the worst thing, but you are capping your upside there. And of course, the same thing we mentioned before with the put spread. So now you only have a limited $5 range of protection to the downside. But on the plus side, you're only paying about $4.50 for that. So not a bad little trade out there, all things considered. Mr. Matt, what are your thoughts about, as you put it, getting devious here by adding the collar? So effectively you have a collar with a put spread kicker there. What are your thoughts on that, sir?
Yeah, that's great. But the problem is these calls, these don't backtest very well. The only good backtest that we had this great backtest of individual stocks. When you're trading market indexes, the vol is so low, the skew is so high, like we talked about earlier, that for example, that 10% out of the market 30 days only trading 10 cents right now, so it's virtually nothing. And the volatility is only 13, whereas the puts that you're buying is 22. So actually, I should correct that. It's more like for the puts that you're buying, 27. So you could see what the skew is doing. It's just, this is what's happening in the market, especially in the indexes. People are selling calls and doing like you're saying, but these volatilities and the skew has gotten to the point where you just can't. It doesn't make any sense, in my view, to be selling these calls. What we found in our testing of over 3 million covered calls is that you need to get something in the order of 1%, and I believe it was a less than 20 delta. So those are hard to find. So you're only going to find those in some selected underlying stocks. So but there are some of those out there. But that's the only way I think that type of a it seems logical to add the calls on there. But again, the markets and what they've done to the volatility of the calls versus the puts make it almost not even worth doing, Mark.
Yeah, the skews are getting pretty crazy out there these days, at the point where if you're going to do a collar, in order to get any sort of real premium off of that put, you have to bring your covered call so close to the at the money that it's effectively like almost selling the underlying at that point, which is not obviously tenable for a lot of people out there. So, Mr. Matt, this has to be, if not the most, perhaps the second or third most common back test request you guys receive over there at ORATS, is how to pay for this type of protection. So we talked about a few different scenarios. What is your preferred MO? What back tests the best? So if someone were to come to you right now with this same example, they have XYZ, they want to hedge themselves, they're sitting on gains, what would be your go-to recommendation, sir?
Yeah, so here's where we're deviating or getting devious. So what you want to do, at least in our testing, and I've been using this for a number of years as well, is you buy these very long-term, way out of the money puts. We're talking 10 delta, maybe 20 delta, but those are way out, like over 365 days. And so and you try to do that not now. You try to do it when just in normal market conditions before the vols, because those have a lot of vega. So you want to make sure you're getting those, just putting them on almost averaging, dollar cost averaging, we'll call it that. And then, interestingly enough, the short put that tests the best and doesn't do as badly when the market's really far down is a very, very short term, like a week, 10 delta, 12 delta, 15 delta. You could still get some decent premium. As we talked about, those skews are still quite steep. And, as they, like right now, as the market starts to correct, the front months really, they blow up in volatility. So you could even get some premium now. So that's that combination, tends to pay for itself. Again, the short puts are that far out, it gets farther out as the volatility goes up, if that makes sense. And, all the vega, what happens in these long-term puts is when this happened yesterday and happened today, and the opposite happened the day before yesterday, is the vega just really is where you're making all your money, is those vegas just crank up. And what you want to try to do is, in a way, is then you want to start to monetize some of those. So, I'll traditionally monetize, like, yesterday I monetized maybe 10% or something like that of the puts. and then it comes up and then you lose that vega again. And then it goes down today and you make the vega again. And then as it goes down again, you still have a lot of bullets because as the market goes down, the volatility expands, the vega expands. And so, the short put, maybe you've bought it in or you're out of it, but these long puts really just explode in value. And so that's the one test and the one strategy, that I like to do. And then you could also throw in some of the ETNs and stuff to help pay for it, but that's a different story.
So just to reiterate there for our audience, you're going out pretty far, at least a year, and buying a pretty cheap, low, sub 20, probably around 10 delta puts out there. And let's say in our example, it's going to be in the S&P. And those would be pretty cheap because they're pretty far out of the money. But also, as you mentioned, they have that kind of tail component to them where the vega can kick in and you can see some pretty impressive gains off puts that were pretty cheap. And then against that, you're going to be selling, I'm assuming on a regular basis in the weeklies, something that's pretty far out as well, somewhere in that 10 delta range. Does that pretty much summarize it, sir?
Yeah, you said it well. And when you see it, when the market's under a lot of duress, you just don't sell those puts that week. And, they're so far out of the money. I'm just going to scan on it real quick right now. These are like the 435. So that's 20 points out of the money right now. So that gives you quite a bit of cushion. So yeah, and that tends to be the way I like to play it. You do have to manage it. You do have to monetize when sometimes we look at 100% profit, 200% profit, 300% profit. So you just start monetizing as it goes down. We had pretty specific rules how to monetize when we were market makers, but if you have a plan in place and you've back tested it, because you could back test under all these exit strategies using our platform. So this is what you want to have your plan. So when it happens, the sky is always falling, but then some people are buying the dip. So what's going to happen? Well, you just monetize some of it. Hedge your happiness is what we used to say. So that's how it takes some managing, but I think that's the way to go, Mark.
And are you doing this on a ratio? Or are you buying more than you're shorting? So you're going out longer term and buying a bunch, like you mentioned. You said you have a lot of bullets in the chamber there.
Yeah, typically, because if you look at that, if you back test that long-term strategy, on average, it loses little less than 1%. If you back test the short put, you're making almost 3%. So you can almost do it 3-to-1. Just depends how, what you're looking for. Are you looking for protection? You can toy with that ratio. So definitely, it's just, that's this isn't a one size fits all. You have to look at these back tests. You should look at the back test, see if it's right for you. But in general, for the general investor out there, that's the type of ratio might be as high as 3 or 4-to-1, as low as 1-to-1.
A little bit different spin on what the traditional modified collar has been, and folks like OIC and others have done studies on this for years, where they take that put that we were talking about buying the 1 month, which is very expensive to roll over time, and just pushing it out, like you said, but not going far out into the cheapy puts, keeping it a relatively near at the money, somewhere out of the money, 5%, maybe 10% at the most out of the money put out there, and pushing that out pretty far. That, of course, used to be what Chris and the team over there at Swan used to do. They used to go out 2 years with their put and then turning around and selling something near term against that, usually probably in the monthlies, maybe if you're pretty aggressive in the weeklies, and then taking that over time. So you have a very long term. In our example, we didn't go out that far. 2 years is pretty far, listeners. I think somewhere around 6 months is an appropriate time frame. For a lot of people, it's viable. You're not paying that much time premium for it. And then over time, if you are diligent with selling premium against it, so you're going to be long that longer term put, and then selling, let's say, a 1 month covered call, and let's say maybe a 1 month short put against it. Now you have some income streams to help offset that long premium. And over time, you can erode away at that outlay so that that protection you bought doesn't cost you as much. And Matt, that's been a pretty common approach, that somewhere around 6 month puts, let's say 5% out of the money again, and then financing it with nearer term covered calls and short puts against it. What are your thoughts on that approach versus what you were talking about, sir?
Yeah, that's not my preferred approach because those 6 months are still, so expensive and decaying, and again, what we found in so many tests is that, what you have to be really careful about what you're short too. So, we're often 5, 6, 7 days. Like I said, there's a lot of cushion there. And we have to get we have a spread yield target. We have, we have an exit profit and loss on profit. We have an exit profit and loss on delta. We have exit on delta. So if it gets anywhere near the money, you're out. So, that's the way to survive those short puts. And then the long kind, yeah, you have to be way, way out there because you need the Vega. And it doesn't matter how close you are necessarily. It's not like that. The protection isn't the percent out of the money. Like a lot of people want to, say, hey, I want to be protected for sure, 10% out of the money. Well, if you go 20, 30, 40% out of the money and you have these small puts, they don't decay very much. But when the volatility goes up, they really pay off. But puts are really what's going to happen is if the market really all goes, everything's going to go. Crypto, bonds, everything goes. So the only thing that's going to be your friend are these puts. So you want to have puts. You have to be careful about hedging with the VIX because even though I'm saying that the volatility is going to go up, the VIX calls sometimes are a little dicey. You never know what's going to happen. So you want to have puts. For sure that that's matched to your long indexes, and so that's the way to go. So hopefully that makes sense, Mark.
The only contractually guaranteed inverse correlation, buying a put out there. So we went through a lot of scenarios. I could see maybe if you're a little bit confused or overwhelmed by that, go back, pause it, go back, maybe listen again, listeners. I will try to summarize it all for you here. You're coming in, you're long an equity, you're long an index for your clients. They're sitting on some gains. They want to buy some protection. How to go about that, of course, there's the very standard 1 month slightly out of the money put that for many reasons we've said right now is very expensive. And if you roll it over time, that's going to be a tremendous drag on your portfolio. You can add layers to that. You can go beyond it, turn that put into a put spread, reduced outlay, but also reduced protection. You can add a collar to that as well. But as we mentioned, given the way the volatility skews are setting up right now, you're not getting a ton of money for that call. So you are surrendering some of your upside for not much return. So you have to weigh if that's worth doing out there as well. Then there are the modified collars. The approach a lot of people like to take is, of course, take that put and push it out farther and then do nearer term premium writing against it. Of course, you have to be pretty diligent with that. You have to know what you're doing. And as Matt mentioned, you have to really be able to babysit and have good rules about when to close out those short legs, lest they come back to bite you. Because in an environment like this, where the market's selling off pretty hard, you have longer term puts. But if you're short a lot of near term stuff against it, that stuff's going to blow up against you pretty quick. So you have to be pretty savvy to be able to manage that. Then let's call it the Matt special. I like this one where you go far out, at least a year, buy some pretty cheap, maybe around 10 delta puts, and buy those on a ratio. So you're buying more than whatever you're selling in the near term. That's going to be somewhere around a similar delta, 10 to 20 delta weekly out of the money puts. And then doing that over time, you will have a lot of what we used to call on the floor bullets in the gun to be able to use on a day like today when everything is melting down. So those are just a few ways you can go out there and pay for the protection that your clients are clamoring for right now. As we keep on rolling really quickly, let's get the buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get the buzz.
All right, let's dive in, listeners. Let's kick things off the way we do every episode, looking back at the month that was, and let's see how it performed. Again, the big question coming into this year was, can the party continue? We have the definitive answer now, listeners, which is resoundingly yes. We said every month was a record. Looked like it was the highest volume, whatever month it was, March, February, June, in the history of the options market. Well, we saw that again in October. October, the highest volume October in the history of the options market, 825.5 million contracts changing hands last month. More importantly, what really makes it definitive for this year is that now if you add up total cleared volume through the end of October, so the entire year, 8.1 billion with a B contracts. Why is that important? Why is that significant, listeners? Well, if you recall last year, 2020 was a record year by just about any metric when it came to options volume. 7.52 billion contracts cleared last year. That was a number most people never thought we would see for ages in the world of options, if ever. It was a ridiculous number. It seemed outlandish. And now here we are, Matt, already just through October, and we've already beaten it by about 0.6 billion contracts out there. I mean, just think about that for a second. We are 600 million contracts past a record insane year, and it's already just the end of October, sir. What say you?
I mean, didn't we used to do 600 million and we were already 6 million past?
That was like a good year's worth of volume way back in the day.
Yeah. No, and like I've said before, look at the money supply. It's almost, you could graph it right on top of option contracts. It's almost like it just goes into the money supply, it goes to the option market. So if they ever turn off the spigot, I think that's going to be the only thing that's going to stop it. But there's so many more people trading these days. At ORATS, we're fielding a lot of people coming in, and new as well as bigger firms are looking for more information. We talked about kind of a strategy that's takes some managing. We're doing a lot to automate that process and to alert you what to do. So this is what we're hearing from our clients, and that's why there are so many more contracts going on. It's just a lot more people coming into the market, and the markets are better. They're much more liquid, and the technology out there is so much better for helping advisors and everybody trade more efficiently and with more data.
There's some topics here. Obviously, when we did our last show last month, the hot discussion point was the launch of the BITO, aka the ProShares Bitcoin options. Finally, advisors had options they could put in a securities account to trade Bitcoin, but we have some data on that. But I think we also have a question about this. Maybe let's combine the two and dive right on into our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. Welcome to the office hours where you folks get to take the reins, ask your questions. Matt, we'll start with you. We got a bit of I guess you can call it a feature request for you from J4340. He says, hey, Mark, any chance you think you could get the Oracle of New Hampshire, he used your proper title at least, to add something to the earnings season report? I was thinking seeing the standard deviation of implied versus actual move would be interesting to see if it is the whole market moving or if it's the whole market having a similar move, or a handful of firms that are skewing the data. Also, an up versus down move metric would have been really interesting to see this season as well. Thanks. Well, Mr. Matt, we just talked about you added the earnings trades reports to the list. Mr. J has some more features. What do you think about these, sir?
Well, when we first came out with these, people's eyes were glazing over, and now they're asking these great questions. So
they love them. They love the earnings data, sir.
Yeah, no, that's a really good way to think about it. Where's it coming from? Is it up or down? It's just it's impressive to see. We've been doing this for a long time, but to see the evolution of these questions and really the education of all the people that are listening in. That's a good question.
All right, so Matt and his team will take it under advisement. They are pretty busy over there, and they already crank out a lot of great reports for you folks. But maybe if they have time, they could do some tweaking over there for you. As we keep on rolling, let's see. Next up, we got this handle, Ramblin'. Ramblin' just says, hello. Well, hello, Ramblin'. He says, I've been listening for a bit now. Been trying to have my current advisor incorporate some allocation to Bitcoin for about a year, but it was an uphill battle. GBTC, that's of course the Grayscale Bitcoin Trust, listeners, was a thought, but it wasn't optionable. So clearly he wants to trade options on Bitcoin. He says, now we have BITO. What are your thoughts about wheel trades in BITO? Would they work better or worse in crypto? Well, a couple of things to unpack. I mentioned we had some data to discuss here on all things BITO. Of course, we do have about a month under our belts now for the new ProShares BITO options, listeners, and they are doing some paper out there right now. The ADV in BITO options is about 68,000 contracts. So that's no slouch. So it's putting up some numbers. If you're wondering what the top positions are out there, it's pretty much all calls all the time in the top 5, which is analogous to what we see on platforms and exchanges like Deribit. You can listen to our crypto rundown program if you want to hear more about that. But the top position right now, the D45s and the D60s, 24,000 and 16,000 respectively out there in BITO. The top 10, the overall top 10 positions are 70-30 calls to puts out there. So still, as you would expect, predominantly call driven out there in Bitcoin land. The vol on BITO is at about 78% when we ran this morning. On Deribit, same thing, 78%. So they're lining up pretty nicely there. From a skew perspective, it was pretty similar as well. We saw about a negative 5.3 on BITO options, I believe. I think it was about a negative 5.5 on Deribit. So we are seeing those products line up very well, which is kind of interesting. But in general, unlike the equities we were just talking about with our collar and our puts, which is the puts are bid and therefore are very expensive, which makes the beginning, the first leg of that wheel, very attractive, which is selling that put. I think a lot of people who get into wheels, they really want to sell the put. Right? They get attracted by that, not so much selling the call. It's going to be the inverse of that in crypto. You're not going to get a lot of juice for that put. The puts aren't very juicy. It's pretty much all calls all the time out there. So what you're going to see on the wheel in a product like BITO or anything else in the crypto space is going to be, you don't get paid a lot to get into it. But once you get in, if you do get assigned, you can get a lot of juice for the upside on the call. So the second leg of that wheel is probably going to be more attractive than the first. Matt, what are your thoughts overall? It's been about a month. If you've had a chance to trade it or watch BITO, and any thoughts that you've seen on how it's performing out there. And then B, this question we have from Ramblin' about wheel trades in it. And do you think they would be effective in this versus a traditional equity?
First of all, I don't know if we actually got it on air, but my first BITO trade was during the show.
Oh, today?
No, the last show.
Was it really? What did you trade?
Yeah, we so I have, I obviously I was on the crypto rundown, so I have a little bit of crypto, a little bit of Bitcoin. So what I've done is I'm basically doing my collar in BITO, and so obviously that's been down, so it's worked out really well. But I think the strategy for BITO, if you want to be long it. You can, I would be long, so let's say, especially when Bitcoin was up at 68, way up there, 66, 68, that's when what you could do is you could transfer some of your, if you don't want to sell it, you can either, you still want the exposure. You may have to sell your actual Bitcoin, but you could move it over, or, I have, it's small enough where I could just sell naked calls. And if it really went against me, I still have the Bitcoin that are going to do well. So that but as you mentioned, selling these calls against owning BITO and having puts, so you do a collar, you could get a really, some of these puts are great. I mean, I was able to monetize a lot of the puts and buy in some of the calls and then wait and then resell them. So it's been, I think the strategy is to be long BITO, so that's that's your crypto, that's your Bitcoin position. And then you could sell it, like BITO's trading, I don't know, 37 or something. And you can sell the 60s for some real money and buy a bunch of puts. And, I'm protecting my other crypto and then, also playing the BITO. So I love it. It's been, it's a great product. It trades, it wasn't trading that liquid when I first started, but now it's so much more liquid. So the fills are pretty decent. And, it moves, right lockstep. I would say, there's a little bit of drag. But nothing compared to the VIX ETN. So it's a great product in my estimation. I wouldn't do the wheel. I would do I would own it, and like you would owning Bitcoin, but then you're able to sell the calls out of the money and finance puts, and the puts can be a lot closer to your buy. So that's the way I play it more.
Funny you mentioned that. I was going to mention something similar, which is, of course, the puts are so cheap, and it's a great scenario for coming in and actually collaring, like we mentioned. You see this in futures options a lot as well. Let's say an ag or a metal, where all of a sudden the upside skew gets very big. It makes it very attractive. You can sell pretty far out of the money calls and buy pretty tight puts and do it maybe even for credits. So it's a very attractive scenario for that. So yeah, what was that, rambling? I would actually think about it the other way. And as Matt mentioned, the drag, we have some updated drag numbers. In fact, Matt, I'm not sure if you heard it. We had the folks from ProShares on the network a couple of weeks ago to answer all these questions about BITO. And they thought initially the estimate was about 1% a month. That was based on what we saw initially. They thought that was a little high, probably going to be about half of that. And it's turning out to be, even less. So it's the drag, you're right, is much more manageable than when we first thought. When everyone was worried it was going to be another VXX, right? It's going to erode to heaven. And so far, we're not seeing that. So that makes it, if you are going to buy and hold the product, even more tenable, let alone the setups we have out there from a collar and from a skew perspective. But unfortunately, listeners, that music means we've come to the end. Man, how an hour flies by when we're talking BITO and paying for puts and all the other fun stuff we squeezed into the show today. A lot of living packed into an hour. But before we go, Mr. Matt, you touched on a lot of cool stuff you guys have cooking over there in the land of ORATs. If folks want to check it out for themselves, or maybe like some of our listeners do, they have very specific questions for you, where should they go? What should they do?
Yeah, I mean, we are working on some of the cool stuff. So it's been a lot of fun. I got a great team. Matt at ORATs is my email. ORATs.com is the site. Just some things that we have this new scanner with some very good theoretical values. We have payoff pictures and what ifs, and it shows you the open interest and just does so many cool things. And then we're working on some alerts and like I said, to manage some of these back tests, you could run your back test right through the scanner and then get alerted if you needed to do those exits that we talked about. So there's just a ton of stuff that way. We talked about the earnings trades. We also have some trend line stuff to set up iron condors. That's coming out. So there's so much going on. So yeah, come on over to orats.com, Mark. ORATS.com. ORATS stands for Options Research and Technology Services. Give them a follow on the old Twitter while you're at it, at OptionRats. Pretty memorable handle. If you like all this data we're talking about, they're always tweeting something cool out over there as well, at OptionRats. And you know where to go check out all the latest from our friends over there at OIC, including their collar study. A little bit dated now. They're going to probably have to update that since the advent of the weeklies and meme names and everything else. But it is one of the more comprehensive studies we have seen on collars across a broad array of assets, not just equities. You can check it out for yourselves and a whole bunch more. Optionseducation.org is the place to go. And we have to go on out of here, but we'll be back again throughout the rest of the week. Education Wednesday coming up tomorrow. So I know for a lot of you advisors out there, maybe you don't want to admit it to your coworker, but education is very important to you when it comes to options. Check out our Options Bootcamp, Options Playbook radio shows. They will definitely get you in fighting shape when it comes to options. And of course, Thursday, we're back with our regular gamut of programs and all the way through into December. Hard to believe we're already into December already. And then another episode of The Advisor's Option. We'll see you then.
Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the SIBO over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development. making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.